Bumble just swiped left on 30% of its team. In its peak years, Bumble was the second most used dating app globally behind Tinder, but it struggled to retain younger users, especially Gen Z, who increasingly favor newer platforms with video-first or AI-driven matching experiences. Recent reports show Bumble's daily active user count plateaued around 1.6 million, with a noticeable decline in Gen Z engagement since mid-2023. The app remains most popular in the US, UK, Australia, and Canada, but in emerging markets, competition from apps like Tantan and Woo has eaten into its share. On June 25, 2025, Bumble laid off around 240 employees, nearly a third of its global workforce. The stock surged as much as 25% in a single day, marking one of Bumble's sharpest rallies in years. Bumble framed the layoffs as a strategic reset, a move to cut costs, refocus on its core product, and reverse stagnating growth, especially among younger users. It's also the first major move under returning founder and CEO Whitney Wolfe Herd, who stepped back into the top job just 3 months ago. So why did the market reward this? Because layoffs mean cost savings, and cost savings mean better margins. Assuming average tech salaries of $100,000 to $150,000, Bumble just saved $24 to $36 million per year. For a company of its size, that's massive. If those savings improve or reduce cash burn, Bumble may have just bought itself time to rebuild and reposition. Bumble's brand is built on values: female empowerment, safety, inclusion. Cutting 30% of staff could hurt team morale, product innovation, and even user trust, especially if safety or moderation teams are impacted. Still, the stock move wasn't just about Bumble. It was part of a wider market pattern. This year alone, Hasbro cut 1,900 jobs. Visa laid off 1,400. Ford cut nearly 4,000 across Europe, because fewer employees equals lower operating costs equals higher earnings per share. It's math Wall Street understands. Let's say a profitable company with 100,000 employees lays off 20% at $200,000 salaries. That's $4 billion in annual savings. If it has a billion shares, that's $4 in EPS boost, possibly a 50% jump in valuation. That's why these events are tradable. It's also why Levelfield's AI tracks them. Levelfield's flags layoff announcements in real time, filtering by company size, profitability, and how stocks react historically. That gives traders a playbook. Jump in early on the pre-market spike, enter after a pullback, or ride the long-term turnaround. Just remember, not all layoffs are bullish. If the company's broken, cuts only delay the fall. But when the fundamentals are strong and leadership has a plan, layoffs like this can signal the start of a comeback. Follow and subscribe for more. Level Fields Elite Investing, Effortless AI.